Hello everyone. I begin today by acknowledging the Ngunnawal and Ngambri people, traditional custodians of the land on which I'm presenting from today, as well as the traditional custodians of the various lands on which you all may be dialing in from, and pay my respects to their elders past and present. I extend that respect to Aboriginal and Torres Strait Islander peoples here today. So hello and welcome to our webinar on market-based accounting for Scope 2 emissions in Australia. My name is George, and I'm joined by my colleagues Georgia, Martina, and Joe. We're from the Climate-Related Disclosure Team at the Clean Energy Regulator, and we run the Corporate Emissions Reduction Transparency Report. We're really excited to see so much interest in this topic, and we hope you all find it both informative and useful. So here's what we'll be running through today. We'll start with an overview of electricity markets in Australia and how the Renewable Energy Target fits over the top of that. Then we'll look at some of the key differences between location and market-based accounting before moving on to how we actually track renewables in the market under a market-based approach and where the emissions from various electricity sources are allocated. And finally, we'll finish up with some examples on the treatment of on-site renewables. All right, let's get to it. It's helpful to understand a bit about how the Australian electricity market works. Now, I will say right now that I've taken liberties to simplify this content. But taking it back to basics, electricity is produced by a generator sent along cables to eventually provide power to a consumer. But the consumer doesn't usually pay money directly to the generator, partly because not all generators are equal, and the average cost of electricity in the grid fluctuates on a half-hourly basis depending on which generators are providing it. Managing this for every electricity consumer would get very messy very quickly. So that's why we have the electricity market, which is the mechanism by which money flows from consumers to generators. In most cases, this occurs via a retailer who purchases electricity from the wholesale market and provides it to the consumer for a fixed price. Generators in turn sell their electricity to the wholesale market via a reverse bidding system, meaning that generators bid the lowest price per megawatt hour they are willing to supply electricity for, and bids are accepted by the market operator in order from lowest to highest until enough electricity is purchased to meet demand for each 5-minute dispatch interval. So in this way, money flows from a consumer to a retailer, to the market operator, to the generator. The generators get paid and the lights stay on. Happy days. So now that we understand the very simplified basics of the electricity market, let's unpack how the Renewable Energy Target fits in, because this forms the backbone of the market-based accounting system in Australia. So back at the turn of the millennium, the Australian government wanted more renewable electricity in the grid. So it set an annually increasing target for how much renewable electricity Australia wanted in its electricity mix, aka a Renewable Energy Target. So this target is now 33,000 gigawatt hours per year. So that's how much renewable electricity needs to be consumed each year. And this will continue out to 2030 when the RET ends. To achieve this, the government devised a scheme to incentivise renewable investment. Enter large-scale generation certificates, or LGCs for short. To be able to track renewable electricity production and consumption, and make sure Australia was meeting its target, the government introduced a certificate trading scheme. The first element of this scheme is that an LGC is attached to each eligible megawatt hour of renewable electricity and issued by the Clean Energy Regulator to the generator. The second part of the scheme is that each year, companies that buy and sell or consume electricity from the wholesale market or other large networks, and these companies are mostly retailers, these companies would have to also buy and surrender to the CER a certain number of LGCs equivalent to a percentage of the electricity they buy. This percentage is the renewable power percentage, and it's set each year such that across all liable companies, the total number of LGCs surrendered is equivalent to the renewable energy target, that is 33,000 gigawatt hours in 2023. Retailers will generally embed the cost of purchasing LGCs into their electricity contract prices, so the cost of meeting the RET is passed on to the consumer. The revenue from the LGCs makes renewable generators more competitive, and the surrender obligations of retailers and other liable entities ensures that enough renewable electricity is entering the market and being consumed to meet the renewable energy target. What this effectively means is that a certain percentage of all electricity we consume on the main grid or other large networks is guaranteed to be renewable, and this can be proven through the traceability mechanism that LGCs provide. But what if we wanted to purchase more electricity beyond the renewable energy target? This is where the voluntary market comes into play. So in addition to the obligatory 18 to 19% that retailers cover with LGC surrenders, consumers have the option of buying LGCs directly from generators and voluntarily surrendering these to the CER. This is most commonly done by large companies through a renewable power purchase agreement that includes LGCs. And for smaller consumers and households, voluntary purchase and surrender of LGCs is usually managed through a service provider, such as a retailer or a renewable energy certificate agent. There's a couple of different ways this can be done, but one common pathway is the Green Power program. So this is essentially the same as buying and surrendering LGCs directly, except that the consumer pays their retailer a premium as part of their supply contract, and in exchange, the retailer is required under law to purchase and voluntarily surrender the LGCs on the consumer's behalf to cover their green power purchases. This program is managed by the New South Wales government, but has become a nationally recognised program. Now, some of you might be wondering why I haven't mentioned anything about small-scale technology certificates, or STCs. And there is a reason for this, and I will touch on this at the end of the presentation, so don't panic. But before moving on, I thought I might stop there and give 5 minutes for questions. So yeah, let me know if you have any questions.
At this stage, there are no questions in the Q&A, so we can wait a bit, or we can move on, and if any more come through, we can ask them at the next break.
Let's wait a minute, let people sort of ponder and see if they have any ideas or thoughts. Nothing coming through yet, Georgia?
No, we just got one through. So does it work the same way in Western Australia?
So I wouldn't want to give you the wrong information. I might come back to you on that question. I believe that it's a similar process, but I know there are some slightly different mechanisms, perhaps due to the way that the grid is managed. But that's a great question, so I'll need to go away and come back to you with the right information on that one.
I'm just publishing something. How do you account for double counting?
That's an excellent question, and we will get into that in the next sort of few slides. So hold that thought, we will get to that. And if you feel I haven't answered it at the end of the presentation, let's come back to that.
I can't see any more at this stage, but if you have posted one and it hasn't come through yet, we'll definitely come back to it.
All right, I'll move on then. So now that we've got a basic understanding of how electricity markets and the RET work, I wanted to discuss how market-based emissions accounting leverages some of those elements and how it differs from location-based accounting. To do that, I wanted to start by showing you a video from the World Resources Institute. So the World Resources Institute develops the Greenhouse Gas Protocol Corporate Standard, which is the go-to emissions accounting standard that is most widely used internationally, to the point where the recently released International Standard for Climate-Related Disclosures references the GHG protocol as the preferred accounting approach. Now, around a decade ago, the World Resources Institute found that many companies wanted to be able to choose where their electricity comes from when accounting for their emissions. So they included a market-based accounting approach in the corporate standard that is separate to the more traditional location-based approach to accounting for Scope 2 emissions. They published this video to explain the key difference between the two.
Hi, my name is Mary Sotos, and I'm with the Greenhouse Gas Protocol Program at World Resources Institute. The GHG protocol creates standards and tools for companies to measure and report their greenhouse gas emissions. And if there's one activity that almost every company does, it's use electricity. Most companies purchase electricity from the grid, typically from a utility or other supplier. The problem for us is that we've seen in the 11 years that we've had our corporate standard, companies have been measuring and reporting electricity emissions in some very different ways. And that's a problem if you're trying to assess performance over time or compare companies' performance to each other. What we've seen is that companies have been calculating these emissions in basically two different ways. The first way is what we now call the location-based method. So this looks at emissions from the average emissions from the power plants on the grids where companies are located. So the idea here is that the grid is this physically interconnected entity, so that when you consume electricity in one place, it's generally coming from power plants that are in the same basic region. The advantage of this method is that it shows accurately the sort of physical dynamics of the grid. The disadvantage is that to reduce those emissions, the only real tool at your disposal is to reduce your consumption. The other method that we've seen companies use is called the market-based method. The idea behind this method is that there are policies about consumer choice, supplier disclosure, and in many places around the world, companies can enter into contracts with individual generators to purchase and consume electricity. And when you're able to document the emissions from these contractual instruments, it actually creates a good incentive for companies to be purchasing low carbon energy. And it's part of this market dynamic and sending a market signal. The difficulty with this method, though, is that it can be difficult to navigate which types of instruments are actually appropriate to reflect in your inventory. So to try and reconcile these two differences, we began a process 4 years ago consulting over 200 stakeholders in 23 different countries. And the final result of this is now the Scope 2 guidance. So this guidance is an amendment to the corporate standard, and it has 3 new features. The first one is that it requires companies to report their emissions according to both of the methods that we've mentioned, the location-based and the market-based. We think this gives a more complete picture, and it's more transparent about the differences between these methods and allows for both levers for reducing emissions to be available to companies. The second thing we did is to introduce quality criteria for the market-based method so that companies would know if their individual piece of information from a contract or their supplier actually meets those criteria and can be used in the market-based method total. Finally, we have some recommendations on what companies should disclose around their purchases, features about the energy generation itself, what type of power it is, and then the policy context as well. This helps stakeholders understand some of the differences between electricity markets around the world. The standard is now available on ghgprotocol.org, and we encourage you to download it and start using it in your GHG inventory. Thank you.
But what do the two approaches, location and market, actually look like in practice? So I'll go through a couple of examples to demonstrate this. So firstly, under a location-based approach, emissions intensity associated with grid electricity is based on the average emissions intensity of all generators in the local area. For Australia, the grid is divided into states for the purposes of approximating the locational emissions intensity of electricity in the grid. This is also called the grid emissions factor. In this example, State 1 has a mix of renewables, coal and gas generation, producing 30 megawatt hours of electricity and emitting 30 tonnes of carbon dioxide equivalent. The average emissions intensity in the state is therefore 1 tonne of carbon dioxide equivalent per megawatt hour. Companies using grid electricity in State 1 therefore report 1 tonne of carbon dioxide for every megawatt hour they consume. Now take a second state where there are more coal generators with a higher emissions intensity, and overall they emit twice as much carbon than State 1. This means State 2's grid emissions factor is twice as high as State 1. So companies consuming electricity from the grid in State 2 report 2 tonnes of carbon dioxide equivalent for every megawatt hour consumed. Now, I will note that these numbers are for illustrative purposes only. 2 tonnes per megawatt hour is ridiculously high. So the GHG protocol publishes this basic rationale for the location-based method. and that's that it's generally easier to apply because it doesn't require complex data and trading systems to be able to track electricity from generator to consumer. It also recognises the physical reality that no one can actually tell an electron where to go. It'll just follow the voltage fluctuations in the grid. It incentivises overall electricity sector reduction efforts, though this actually puts more pressure on governments to enact sweeping policy rather than consumers that have minimal investment power. And the lack of consumer power to reduce grid intensity means individuals are more likely to manage emissions through installing on-site solar when using this approach. Now looking at the market-based or contractual method, under this method, consumers are able to actively procure electricity through a contractual instrument and assign the associated emissions intensity of a specific generator to their electricity consumption, regardless of where their physical electricity is actually coming from. So you can see here that this company has chosen to procure 10 megawatt hours of electricity from renewable generators that emit 0 tons of CO2. So they get to say that their electricity is 0 emissions. The emissions intensity of all the other generators is combined and shared across all other electricity users, as shown in the grey box there. The combined emissions intensity of the remaining generators is referred to as the residual mix factor. And in practice, it's an approximation of the grid emissions factor if all claimable renewables were removed from the total generation. What you might have noticed is that compared with the location-based example, there are winners and losers under the market-based accounting method, with winners being those who choose to procure renewable electricity or who are in areas with a higher location-based factor and so benefit from a lower residual mix factor. And the losers are those being who are in areas with a lower location-based factor that don't actively procure renewable electricity. Again, the GHG protocol published this basic rationale for the market-based method, and ultimately it comes down to the power of consumer choice to drive the energy transition, rewarding companies who are willing to pay a premium to buy renewables. It also recognises that the flow of money from consumers to generators is largely managed through contractual instruments, and so the renewable energy attributes of generators should flow back to those who pay the generators. We'll stop for another question break, just to gauge people's understanding of the difference between location and market-based accounting. So, Georgia, do we have any more questions coming through?
Yes, we do have a couple, some linked to this, something. I'll throw them to you and then you can see how we go. So any thoughts on how Chris Bowen's announcement yesterday may impact LGCs in the calculation of the RPP? I'm not sure if that's something you can comment on.
It's a very interesting question. I think it's probably too early to comment on that. That'd be something that we'd want to run by our own economic analysis team. So I can't really comment on that at this stage, I'm afraid. Sorry.
So SBTI and the GHG protocol are questioning the use of REC's RECs under the market-based approach. Is the CER actively involved in the public surveys conducted?
We have been monitoring and keeping abreast of the developments in that space. We haven't been actively involved in the discussion though, no.
Question, does a liable entity need to be connected to a national electricity grid? E.g., could a large-scale consumer on the NWIS still be a liable entity?
Potentially, yes, and that depends on a couple of things, but liability is determined by the energy acquisitions, which is a fancy way of saying purchases or imports or what have you. It depends whether the electricity that's acquired is on a liable network. And the threshold for that, I think, is a network with a combined generator capacity of 100 megawatt hours. I can't recall off the top of my head whether that's AC or DC, but if you wanted more clarity on that, please shoot through an email and we can come back with exactly what the legislation says on that. But yeah, it's about 100 megawatt hours constitutes a liable network, and then a consumer or retailer purchasing on that network would be liable.
I have a bunch that have come through that I have not been able to publish yet, but I will get them out. So is the market-based method ever likely to be split between the NEM and WEM rather than one national figure?
Yeah, so that's probably a policy question that's better directed towards Department of Climate Change, who are now the policy lead on developing the market-based approach for the National Greenhouse and Energy Reporting Scheme. We have been involved in those discussions, and I do believe that their consultation paper that came out earlier this year did flag that that was a possibility, that they could look to refine the market-based method to individual grids or smaller, depending on how granular and when the data was granular enough to be able to do that. So I think if that's something that there's a desire for, I'd encourage stakeholders to engage with the ENGA amendment consultation process, which usually runs from March to April.
I think you might cover this later, but when a consumer is also a generator of LGCs and they are selling LGCs, is it correct that under a location-based reporting, you can both claim the use of renewable electricity while selling the LGCs?
Yeah, so to unpack that further, I think there's some examples later in this presentation that talk to that. But I think the key thing to remember is that location-based doesn't use LGCs and market-based does, but you can never actually compare the two. So if one company is using location-based accounting, it can't really be compared to another company's market-based emissions, because that would introduce an inherent double counting. And I do think we get to that in the next few slides. So that might be a good segue to move on to the next slide, in fact, unless there's some more burning questions. I'm going to take that as a no, and I'm going to move on. Thanks for the great questions, everyone. Yeah, it's really exciting to see all the interest that this topic generates. Okay, so moving on. As we saw at the start of the presentation, in Australia, there can be a few different transactions connected to 1 megawatt hour of renewable generation. So first, you can have the physical transfer of energy from the point of generation to the point of consumption. So electricity enters the grid at some point, flows along power lines according to the voltage fluctuations, and mixes with electricity from other generators before being consumed at some other point on the network. No one can actually control where a single generator's electricity will physically end up being consumed. The second transaction we might have is a contract, which is usually a financial instrument to secure a set price. So these are sometimes called offtake agreements or power purchase agreements, and they can exist between a generator and a retailer or a large consumer, such as an aluminium smelter, and they allow both the purchaser and generator to lock in a fixed price, which reduces economic uncertainty for investors. Retailers will use these to enable long-term fixed price contracts with their customers, typically. And for large consumers, the contract may be in parallel to a retail supply contract, which at that point is typically there to cover the cost of the poles and wires. And lastly, we have a certificate that can be traded and surrendered to the CER. We've covered the details of this in the previous slide, so I won't repeat them here. But I will mention that the RET was cleverly designed such that it actually has all the elements required of the type of renewable energy tracking mechanism recommended for use by the Greenhouse Gas Protocol corporate standard. So we've got these three transactional relationships associated with the same megawatt hour of electricity, but it is important that the same megawatt hour is only counted once in the system. Otherwise, we're essentially devaluing renewable energy. We don't want that. Counting it twice or more is commonly referred to as double counting. And then, so which one of these would represent a legitimate claim to renewable electricity consumption is the question. So the Australian government has decided that LGCs represent the mechanism by which consumers can proactively procure renewable electricity. And this is based on the principle that sourcing an LGC essentially proves that 1 megawatt hour of electricity consumption was matched by renewables in the grid. Surrendering it takes it out of circulation, so it can't be claimed by another party. And so this is the point at which the renewable electricity can be claimed. Now, as we touched on previously, it's important to keep in mind that this applies under the market-based accounting method only, and that under location-based accounting, the average mix of electricity in the grid, which includes large-scale renewables, is actually shared across all consumers. So for this reason, the two methods must be considered as parallel but completely separate accounting systems. And we can't actually compare the two without inherent double counting. Okay, so far we've been focused on LGCs that are purchased from generators and surrendered, but not all renewable electricity is credited with LGCs, and not all renewable electricity is actually exported to the grid. So let's take a look at where the emissions intensity of various electricity sources is counted. So we can have large-scale renewables that are credited with LGCs, and these then have their renewable energy attributes attached to those LGCs. So the LGCs may end up being surrendered to meet the mandatory RET, at which point the emissions benefit is shared across all grid consumption via the national RPP. Alternatively, the LGCs can end up being voluntarily surrendered by or on behalf of an individual, at which point the emissions benefit is allocated to that individual. Importantly, it doesn't matter where the physical energy ends up being consumed, because the renewable energy attributes remain with the LGC. We can also have large-scale renewables that are not credited with LGCs. So this could be below baseline renewables or renewables from generators that aren't registered under the RET. And this might be consumed on site, in which case it's reported as zero emissions electricity use by the individual. And then for any electricity exported to the grid from these systems, this becomes part of the residual mix. And the associated emissions are then shared across consumers via the residual mix factor. Now, at the moment, the government approach to market-based accounting doesn't recognise contractual arrangements for this electricity. And comments and questions around this policy decision are best directed to the Department of Climate Change. But my understanding is that part of the reason for this is that there's often limited transparency of the nature of these agreements, and that makes it difficult to trace at scale to ensure that there's no double counting taking place. And we also have small-scale renewables, for example, distributed rooftop PV. Now, for the purposes of market-based accounting, these are treated the same way as large-scale renewables that don't get LGCs. That is, there's no claimable certificate attached to it. And again, we'll talk about the STC side of things later. But because there's no certificate, it can be reported individually if it's consumed on site and without any certificate surrender requirement. And then when it's exported to the grid, it's not tracked in the grid, so it's essentially shared as part of the residual mix factor. And finally, all other generation is either exported to the grid and shared, or it's reported individually if it's consumed on site. Again, and I'll keep reiterating this, once an LGC is created, the renewable energy attributes of the associated electricity are attached to that LGC and can only be claimed through the surrender of the LGC. So to sum up the last couple of slides, some renewables are shared and some are claimed individually. Shared renewables are automatically included in any electricity consumed from the grid. And this includes the LGCs that are surrendered to meet the national RET, which, as we've said, covers about 18 to 19% of grid consumption in 2023. And also for consumers in the ACT, the LGCs that the ACT government surrenders to meet its jurisdictional target are included in the grid. And this covers about 74% of ACT grid consumption. And then all other renewable electricity exported to the grid, where the generation isn't credited with LGCs, this electricity is combined with all other generation in the grid when estimating the residual mix factor. So the emissions benefit is shared across the grid in that way, because those renewables effectively reduce the emissions intensity and therefore share the renewable electricity across all consumers. Now, it's worth noting that emissions-intensive trade-exposed activities are exempt from the RET. What this means is that the retailers or other liable entities don't need to surrender the 18 to 19% worth of LGCs for this electricity. So for this reason, these activities don't automatically receive the RPP share of renewables in the electricity imported from the grid. All right, I'll stop for another question break because I do understand that some of this content is quite dense. I'd like to give you all time to think and digest. So Georgia, do we have any more questions?
Yes, we do. We've had quite a few come through, so some of them might be for some of the earlier slides as well. So someone just wants to clarify that all renewable electricity generated in market-based accounting methods, so voluntary LGCs, is removed from the grid average, sorry.
Yes. If it's credited with LGCs, it's removed from the grid average. If it's not, then it's not. I hope that makes sense.
So I've got another question here. I will just read it out. So the ENGA changes to allow voluntary market-based reporting is a step in the right direction, but as long as location and market-based is an option, double counting will stay the issue. So will there be a shift to only market-based?
Yeah, it's an interesting question, and again, one that's probably not for us to comment on. It's more of a policy question for the Department of Climate Change. I do know that Climate Active's recent proposal, if people have been keeping across that, they're proposing to make market-based accounting the mandatory approach for obtaining certification. So make of that what you will. But I do recognise that there is quite a trend towards market-based, and it is gaining quite a bit of attraction. Again, going back to that point that it kind of unlocks the power of consumer choice to be able to drive the energy transition. But yeah, I can't really preempt any sort of policy decisions on that. Sorry.
So someone else has asked, are mandatory LGCs surrendered for RPP compliance by a retailer on behalf of a consumer, so under a PPA, classified as eligible renewable energy certificates for the purpose of calculating a customer's Scope 2 market-based emissions?
So all LGCs that are surrendered by a retailer or liable entity to meet their mandatory RET obligations, they flow through to the RPP percentage that's actually attached to any imports at the consumer point of consumption. So they would flow through. I'm unsure that, if I can understand the question, that a retailer would have a PPA with a consumer to mandatorily surrender LGCs under the RET, because I don't really understand whether that would make sense, because they're required to surrender those anyway. when they surrendered them to the CER, they're surrendering it for all the electricity they acquire, not for the electricity they on sell necessarily. So I don't know if the retailer would be able to pick and choose where it's going, because it has to cover all their electricity, right? And that's the 18%. I don't know if I've answered that correctly, but please, happy to discuss further if you want to send through an email after the presentation.
Should we do one more?
Yeah, I think we've got time for one more.
Cool. So, is market-based accounting based on firmed renewable procurement? So, i.e. firmed by renewable rather than black?
So the firming question doesn't really come into it under the approach that we're currently using. So recognizing that firm PPAs are a thing, because it ensures that variable generation can be backed up. But the current market-based method is reliant on the creation and surrender of LGCs, regardless of whether the generators that create the LGCs are backed up with a firming capacity or not. All right, I think I might move on then. So we'll move on to our penultimate section, which is the treatment of on-site renewables. Now, this is an area that often trips people up, we've seen through administering the CERT report. So I just wanted to go through a few examples of how it works. So on-site renewables, sometimes called behind-the-meter consumption, because it's consumed directly from an on-site generator and never passes a building's metering point, i.e. it stays behind the meter. Under market-based accounting, the treatment and the resulting emissions intensity of renewable electricity generated and consumed on-site ultimately depends on whether it is credited with LGCs and what happens to those LGCs. Now, this is to prevent the same electricity being claimed in two different places, and I'll work through a few examples to explain. So in this scenario, we have a company that produces 5 megawatt hours of electricity from their on-site solar panels. All of this generation is credited with LGCs, but only 4 megawatt hours is consumed on-site, while 1 megawatt hour is exported to the grid. The company surrenders 4 LGCs to cover the 4 megawatt hours they consume, and so the on-site consumption is assigned the zero emissions renewable energy attributes attached to those LGCs. The residual electricity, i.e. electricity not considered renewable, is zero in this case, and so their residual Scope 2 emissions for market-based accounting are also zero. In the second example, we've got the same setup, except the company sells all of their LGCs to generate some income. Now, the zero emissions renewable energy attributes are attached to the LGCs, which have now been transferred to another party who may decide to use these in their own market-based accounting boundary, or to meet mandatory obligations under the RET. To avoid double counting, the on-site renewable electricity consumption cannot be treated as zero emissions, and is instead treated as residual electricity, as if it were imported from the grid. It's assigned the residual mix factor of 0.8 tonnes of carbon dioxide equivalent per megawatt hour, and the company's residual Scope 2 emissions are therefore 3.2 tonnes of CO2 equivalent. In this third scenario, we've got the same setup, but this time the company surrenders 3 of their LGCs and sells the other 2. The 3 LGCs surrendered allow the company to claim the associated renewable energy attributes for 3 megawatt hours of on-site consumption, and that leaves 1 megawatt hour of residual electricity to be treated as if it were imported from the grid. So the company's residual Scope 2 emissions in this case are 0.8 tonnes of CO2 equivalent. Now in this last example, again, we're generating 5 megawatt hours, consuming 4 and exporting 1, but none of the generation is credited with LGCs. Now, this might be because it's a small-scale system, or it's a generator or generation that falls below the generator's 1997 pre-RET baseline. But either way, the on-site consumption is treated as zero emissions renewable electricity because there is no certificate to which the renewable energy attributes are attached. This means the company claims the zero emissions benefit, and their residual Scope 2 emissions are zero. Now, lastly, we get to STCs. So remember when I mentioned, or rather didn't mention STCs? Well, this is why. So the small scale technology percentage, which STP for short, is similar to the RPP in that it's the percentage of traded electricity that liable entities, remember retailers, must cover with small scale technology certificates as part of the small scale renewable energy scheme. But the STP is set each year based on the forecast rooftop PV installations for the year and the related STC creations. And it's such that all the forecast STC creations are used up in meeting the RET STP liability. And then any actual STC over or under creations for the year are carried over to the next year when determining the next year's small-scale technology percentage. What this means is that the STC market is effectively a closed loop because all STCs go towards mandatory obligations. And that means there's no STCs left over for the voluntary market. That brings us to the end of our presentation. So let's have another round of questions. If there's any more coming through, or we can revisit some of the ones from the previous sections.
Yes, so there is a couple of questions here about sort of the boundaries of RMF. So whether there is plans to publish a state-based RMF, or if the RMF will just be calculated off NEM, or whether it's going to be, there's going to be a state-based RMF for market-based accounting. So that's just sort of me collating a couple of questions in there.
Mm-hmm. Yeah. So that's kind of the same answer as around the grid-based RMFs, in that it's a policy question for the department, which I can't really preempt. But if there is a desire to disaggregate the national RMF down to grid or state levels, I'd encourage stakeholders to engage with the ENGA amendment consultation process. Again, there's some trickiness in disaggregating LGC creations by the grid due to the way data has been historically collected. And I think, I think if there is appetite to move towards more granular RMFs, we'd need to look at that data question before that can be resolved.
So we've got a question here about the RPP. So if the RET remains as it is it reasonable to assume that RPP will remain relatively stable to 2030, as the LRET will remain constant at 33 million? Sorry, noting that RPP may even peak and decline as total generation increases, which is disconnected from the physical reality of renewable generation increasing year on year.
Yeah, it's an interesting question and point. I feel like that's probably a question for our economic analysis section, who sort of look at some of that stuff, or the forecasting section of the department.
So we have another question here about whether we can clarify which mechanisms, so legislative or otherwise, use location-based and market-based accounting methods.
So in Australia, I'm aware of, obviously the Climate Active program uses location and market-based accounting. The Corporate Emissions Reduction Transparency Report uses location and market-based accounting. The National Greenhouse and Energy Reporting Scheme also now has a legislated optional market-based accounting method. Locational is mandatory, but the market-based is optional. And the Treasury's proposal for mandatory climate-related disclosures is looking to leverage the ENGA methodology where it's available, and based on my reading of their proposal, market-based would be mandatory at some point in the future. But again, that's probably a policy question to be directed towards Treasury. Yeah, that's probably as much as I can say on that for now.
Sorry, my questions are taking a second to load, but someone did ask about the exclusion of the emissions intensive trade exposed entities, just for some more clarity on that.
Yeah, so the way I sort of think about this is that when we have a liable entity surrendering 18 to 19% of their electricity acquisitions equivalent in LGCs, that covers a certain amount of electricity that they're then trading on, but it excludes activities that are ET's activities, which means that the liable entity isn't surrendering LGCs, like the 18 to 19% worth of LGCs for that activity. So in that sense, because the retailer is then not passing on costs of the RET to those activities, they can't claim the RPP percentage towards those activities. It's just not surrendered for as part of the mandatory obligations.
Just waiting for them to load again. I will just remind people that if we don't get to any of your questions, or if you want further clarity, just to send us through an email. And also if you would like a copy of the slides, because we have had a couple of questions come in asking for the slides to be shared, just send us an email and we'll get back to you.
George and Georgia, it's Martina here. We've got a couple that have questions that have come through by email, so I can talk to those if that helps. It's about Scope 2 market-based accounting. In the formula approach developed by the Clean Energy Regulator to calculate the Scope 2 market-based accounting, does a consumer need to consider Scope 1 allowance in order to disclose their Scope 2 market-based accounting? If yes, is there any guidance in calculating this?
That might be one we need to get more clarity from the asker on. I can talk to what I think they're asking, which is whether electricity generated on site that produces Scope 1 emissions needs to be considered. And for the purposes of the CERT report and for the ENGA optional market-based method, those emissions will still show up in your Scope 1 emissions. That doesn't change. So when we're calculating residual Scope 2 market-based emissions, the on-site generation from fossil fuels is excluded from that Scope 2 amount because it appears in the Scope 1. I hope that makes sense and answers that question. But again, we can go back to the asker via email to ask for more clarity if that hasn't answered it.
Thank you.
How are we looking for time, Georgia?
We are currently sitting right on 4 o'clock.
Well, I think that's probably a good spot to end it. So again, thanks everyone for your interest in this topic. I hope you've found the presentation useful and informative. Again, email us if you want a copy of the slides or have any other questions we didn't get to. You could email that email, or if you want to contact us directly, I think most of you probably have our address, but I'll reiterate it. It's cer-cert@cer.gov.au. So yeah, feel free to contact us there if you have any follow-up questions. Thanks again, everyone, and I'll let you go and enjoy the rest of your Thursday afternoons. Hopefully it's relatively dry where you are. Have a good Thursday. Thank you.